The system is falling apart in front of our eyes. The old world is collapsing. Hurling trillions into the market weekly, and it's still falling apart. This is epic. Fed goes to 0%, injects billions into the stock market, and Dow Jones plummets. This is the same as someone in the hospital who is getting drips, injections to keep them alive, and their tolerance builds up, so they need more and more, then their veins collapse, they go septic and die. The Dow and the S&P 500 are having the worst month since October 1987. Repo doesn't work anymore because they've done it too many times, and the credit markets are saturated. So far, the latest Fed injections haven't done much to lift the Dow. The Fed's gone to 0%, and the quantitative easing levels are unprecedentedly high. The Dow opened down 10% this morning with the S&P 500 down 7.5%, tripping the 7% circuit breaker, which stopped trading for 15 minutes. This is after the Fed on Sunday unexpectedly dropped the Fed funds rate by 100 basis points to virtually 0% and said it would add at least $700 billion to its balance sheet. While the indexes have recovered a bit, they are still down around 7% as of noon, and keep an eye out for a dead cat bounce. The New York Fed announced Monday it would conduct an additional overnight repo operation at 1:30 p.m. Eastern. This operation will be conducted for up to an aggregate offered amount of $500 billion. This while Kudlow announces that the Trump administration is readying another $400 billion boosts to the economy. This is called desperation. The Dow closed at 19,827.25 on President Trump's inauguration day, January 20, 2017. Today the Dow stands at 21,425. A gain of nearly 1,600 points, or a gain of 7% in just over 3 years, or 2.3% per year. If President Trump were a fund manager, his performance would be among the worst in recorded financial history. Who could have ever guessed that you can cure a disease by central banks simultaneously printing cash? The Fed is stuck throwing even more liquidity at the problem. There is no way the dollar survives this kinda insanity. Before computers, the printing presses served as a brake on how much money the Fed could produce. Today there are no restraints on money creation, and we are witnessing the results. The governments and central banks around the world have not learned to take note from those that know the dangers of embarking on monetary madness by throwing trillions upon trillions of digital currency backed by thin air at failing economies. The same people are unable to interpret the past, read the present, and to imagine and empower the future. They are living a life without a punchline, clueless about what to do amid the catastrophe that is currently unfolding. A worrying situation for those with hard-earned savings that are diminishing each day with devalued currencies. Central banks are able to print currency but will be unable to print confidence. As of February 2020, federal debt held by the public is $17.23 trillion, and intragovernmental holdings were $6.02 trillion, for a total national debt of $23.3 trillion. Goldman Sachs now says that the U.S. GDP could fall 5% in the second quarter. That would mark the biggest annualized drop since the fourth quarter of 2008. The financial Frankenstein debt bubble has not yet burst, but it will. The bubblegum law states the bigger the bubble, the greater the chance it will blow up in your face. The Fed bubblegum law states, so long as it is not in my face, and they pay me for it, I will keep making bubblegum out of nothing. This is the biggest scam in history. The private federal bank creates money with a click on their computer and buys your house with made-up money, and then they rent your house back to you, and while you are paying them rent you are also paying them interest on the money they created. The trouble with being honest and trusting is that shysters will take advantage of you. All of this is so ridiculous and nightmarish. Those people only care about keeping the financial markets afloat. They care nothing about Americans sickening and dying. The coronavirus has nothing to do with financial markets. And it has nothing to do with them ushering in more trillions of dollars of debt. They will use any excuse. The government asking everyone not to take their cash out of the bank will strike even more fear in the hearts of men. They are doing the complete opposite of what they should be doing to calm the masses. Expect bank runs, food runs, and chaos in the streets. Bank closures already starting. New Orleans Capital One Bank is announcing this morning that it will temporarily close 12 branches in Louisiana. Toilet paper and water runs, now bank runs. But we all saw this coming. Panic on Main Street and panic on Wall Street. The end game is either global reset or all-out war. The world is about to change radically. Welcome back to the Atlantis Report. Please take some time to subscribe to my backup channels. I do upload videos there, too, on a daily basis. You'll find the links in the description box. You will also find a PayPal link, if you want to make a donation. Thank you. So this is what the death throes of the unsustainable debt-based system looks like. Do whatever you can to distract the populace as you throw trillions into the void daily to keep the illusion from falling apart. Print money out of nothing. Buy company stock. Eventually own all the companies. The public seems okay with it, so it will continue. I don't recall granting these guys the right to steal from my children every time they get a whim to do so. Funny how these arrogant people think they can control the economy. They do all the wrong things at the wrong time. The biggest funny is how people think they have intelligence in all of this. They don't. Politicians are finally getting through their thick skulls that the health and safety of the planet trumps stocks. I fully expect every G7 country to go into lockdown within the week. This will be a unique opportunity to write off the debt and to reset things. The circuit breaks tripped again, and the market is still below Friday's close. The Federal No Reserve Trade Desk piled in and tried to buy the indexes across the board on Friday at last minute just before the close according to my real-time charts. I see this all the time. The Fed was trying to pump the market up. They were pumping it up Friday, getting ready for the announcement on Sunday afternoon regarding the zero interest rates. There are throngs of corporations lining up for public bailouts. Everything from airlines, to big oil and big pharma. And here is a heads up. You the taxpayer will be bailing them out. You have no power to say no. Your vote does not count. You have no voice. There are too many bubbles. Way too many. Premiums over spot on precious metals have started to climb. If rates are lowered mid-week, people might want to get their funds out of banks. And nobody wants the stinking US Treasuries, not even US banks who are drowning in them. Can you see the currency crisis coming? Under fiat money, debt is money. And money is wealth. Since the bond market low of 1981, every dollar borrowed and spent created at least $2 of wealth. The spent dollar bounced around the GDP-counted economy. A second dollar, an asset, a receivable, was placed on the bondholder's balance sheet. 2 or more for 1. Why it was magical. And for 39 years of bond bull market, as the price of debt rose, the quantity of it demanded by investors rose too. So the price people were willing to pay skyrocketed, even as the total quantity in existence filled a veritable ocean of IOUs. Imagine an ocean, 1,000,000 square miles but a foot deep. Today, a bond is floated, and instead of pricing at near zero yield, it prices significantly below that. The difference between last trade, near 100%, and now, a lot lower, comes off every other existing bond in the ocean. Imagine today's bond is a single square mile. Its shortfall in price comes off every one of the million already in existence, even though only one bond traded. This is marginal value as it applies to the whole. We watch the price and yield of the 10-year note and 30-year bond. They recently hit all-time highs, low yield, but since this crisis grew and the Fed panicked, their prices are dropping. If that is the beginning of a trend, then the wealth in the bond ocean is set to evaporate across the board, taking with it unimaginable amounts of wealth, and the wealth effect on stocks and the real economy. The Fed can print credit as long as someone will borrow it into existence. The Fed cannot print product or production. All it can do is debase the value of real capital, and this is what it did in spades. 39 years of debt growth deformed the US and world economies to serve debt-enabled demand instead of what would have occurred organically. Here is a useful metaphor: a town experiences a huge credit bubble, so its residents build 5,000 square feet mansions. When the bubble bursts, no one can afford to maintain, heat, cool, or pay the property taxes on said mansions, so they fall into disrepair and rot. Absent the credit bubble, residents would have built 1,800 square feet ranch houses, which they'd still be able to maintain. So the full effect of the bubble is to literally destroy what would have been, and destroy what was. Every industry now addicted to debt-fueled demand, medical services and insurance, the welfare state administration, higher ed, the old but hardly forgotten military-industrial complex, etc., grew to mountainous proportion these past 40 years. They are all unsustainable, and the people they employ face a catastrophic collapse in the demand for their services. It didn't have to be. We were all sold the big lie for a very long time. The banks are, on average, leveraged up 100 to 1 on derivatives. Throwing $6 trillion or even $100 trillion at the problem is like throwing a cough drop to a terminal pancreatic cancer patient. Tens of trillions in Federal Reserve digital currency won't get us out of this mess. All are begging now for a market close. Next, banks close their doors. Better get whatever you need out of the safety deposit box if you have one. The banksters are stealing everything. The peasantry will be starving to death while the oligarchs are all ordering new, bigger yachts. This was the Atlantis Report. Please like, share, subscribe. And please take some time to subscribe to my backup channels. I do upload videos there too, on a daily basis. You'll find the links in the description box. You will also find a PayPal link, if you want to make a donation. Thank you. Thank you. America is bankrupt. Fiscally, America is kaput. America is broke. The U.S. public debt situation is presently the worst since World War II. America's big problem is that there are too many welfare queens, both corporate and personal. The productive cannot support the non-productive anymore. Simple math. The ones who should really be afraid are the ones who can't live without a government nipple in their mouth. Unfortunately, there are a lot of those types, because government policy has been to create as many dependents on government as possible. California's blackouts, where the stupid TV doesn't work, could actually become an epiphany for some people to find better things to do. 50 years of globalism created a couple of hundred billionaires and bankrupted everyone else. 1913, the year control of the economy was given to foreign banks. 1963, Kennedy hit, the year the middle class was assassinated. $40 trillion of pension funds invested by Wall Street in China alone. $21 trillion of debt run up. 30 million U.S. jobs offshore to China, including 6 million manufacturing jobs. 100 million immigrated into the U.S. in the past 50 years. 50 million illegals. 63% of all immigrants now on welfare, and the rate increases every year. 2 million green cards and H-1B visas per year to drive wages down. $40 trillion paid in welfare reparations with zero effect. America is broke, China is worse, the EU is toast, and Russia, even if not in as much debt, is not far behind. If we catch a cold, the world gets pneumonia. Know that much. The debt storm approaches, slowly, then all at once devour everyone. No one shall escape. America is the Titanic and it is sinking in an ocean of debt. Welcome to the Atlantis Report. Here are some figures about the insane level of debt and taxes in America. Total mortgage debt rose to $9.4 trillion, $1.48 in student loans, $2.5 trillion in other consumers' credit-related debt. Total auto debt in Q2 of 2019 is $1.3 trillion. Credit card loans crossed the $1 trillion marks. Corporate debt is at record highs, standing at $10 trillion. And they continue to increase. The U.S. is running up its debt over $1 trillion a year, with $21 trillion already on the books and promises to its retirees and Social Security recipients of another $200 trillion. We passed the signpost some years ago, and into the twilight zone is where we are headed. Wall Street has reported record profits this year. Average bonuses for bankers have risen by as high as 40% from last year. And that's hard to hear for everyone on Main Street suffering the effects of the global crisis. The banks want us to pay their bad debts. They are not too big to fail, they are a bunch of money junkies that want every penny we worked for. And here is more sickening food for thought. Americans owe over $11 trillion in home mortgage debt, and that's just for 1 to 4 family. It does not include multi-family and commercial mortgage debt. That number was only $2.6 trillion in 1990, now less than 20 years later it is over $11 trillion. And we owe over $2.5 trillion in another consumer credit-related debt: cars, boats, RVs, credit cards. Credit cards make up a little less than $1 trillion of that $2.5 trillion total. That number was up from $800 billion in 1990. So, just in home mortgage and consumer-related debt, we owe almost $14 trillion on assets that are very likely worth less than we paid for them. What's worse, we do not pay the low interest rates on our debt that the government spends on its debt. Total mortgage debt rose to $9.4 trillion, an increase of $407 billion from the same juncture in 2017. Household debt has been growing for 5 years, but mortgage balance growth has been on a slower incline since it stopped declining in 2013. Total auto debt in Q2 of 2019 is $1.3 trillion, a jump of $59 billion from the same time in 2018. When the Federal Reserve lowered interest rates in 2008 to fight the recession, giving consumers more incentive to pursue the typical 3 to 5 year loan for autos, it kick-started a trend that has held true today. Auto loans continue to increase because of low interest rates. Student loans, they continue to escalate, growing to a record $1.48 trillion in Q2 of 2019, up to $73 billion from the same juncture in 2018. When the federal government assumed control of the student loan program, replacing the previous administrator, costs were cut, and the availability of education assistance was increased. The loans are guaranteed, and it's seemingly a win-win, lower interest rates to encourage higher education, although the rise of student loan debt has been staggering. Credit card loans crossed the $1 trillion mark, reaching $1.08 trillion in Q3 of 2019. Credit card debt, considered revolving debt because it's meant to be paid off each month, is only 26.2% of the total liability after accounting for 38% of the total debt in 2008. When the Bankruptcy Protection Act of 2005 was passed, making it more difficult for people to file for bankruptcy, there was a turn toward credit cards in a desperate attempt to pay bills. So credit card debt soared, reaching its all-time peak of $1.028 trillion in July 2008, an average of $8,640 per household. Most of that debt was due to unexpected medical bills. Credit card use took a hit during the recession, falling more than 10% in each of the first 3 months of 2009. Banks followed suit, cutting back on consumer lending when the Dodd-Frank Wall Street Reform Act increased regulations over credit cards. By April 2011, credit card debt fell to $839.6 billion, a figure that has remained somewhat flat, although the average American household still owes $8,398. People are freaking out about the national debt, but at least the government can tax and print money. And how about state debt? While Americans as a whole carry significant amounts of debt, each state has its own unique problems. The makeup of state-specific debt reflects not just the national economy but also factors like unemployment rates, the worth of homes, and the cost of college. Here's a quick look at some of the states whose residents have the highest debt levels in the country. Credit policies long pursued by central bankers based on the Keynesian model of rising inflation have brought the United States to the brink of economic collapse. In the final analysis, even wealthy nations cannot afford to live beyond their means to support progressives, social justice, welfare programs. Nearly all the developed world is at the Keynesian endgame, and the end of the dollar unless we find a wholly new source of national wealth. Globalization and free trade agreements have led to the outsourcing of well-paying jobs from the advanced nations and a boost to the growth of developing countries. Unless reversed, this trend will continue to the detriment and ultimate collapse of Western economies. We must become net exporters and keep balanced budgets. Due to the current misguided policies, unemployment is going to climb and will probably stay high for years to come. We need job-friendly, business-friendly, profit-friendly policies that lure jobs back to the US and keep people from going out of business and encourage people to start businesses. What they are proposing is just the opposite. Scary, scary stuff indeed. The power of finance was the power of debt. Bank credit takes future prosperity and moves it into today. This can be useful to allow business and industry to expand now, rather than later. To allow you to buy a house early in life, and make use of it, rather than later, when you don't have long to go. Unfortunately, it has been used the wrong way during globalization. Using future prosperity to inflate asset prices today. Real estate does make the economy boom, but there is no actual wealth creation in inflating asset prices. This is what is really happening. When you use bank credit to inflate asset prices, the debt rises much faster than GDP. The bank credit of mortgages is bringing future spending power today. Bank loans create money, and the repayment of debt to banks destroys wealth. In the real estate boom, new money pours into the economy from mortgage lending, fueling a boom in the real economy, which feeds back into the real estate boom. The Japanese real estate boom of the 1980s was so excessive the people even commented on the excess money, and everyone enjoyed spending that excess money in the economy. In the real estate bust, debt repayments to banks destroy money and push the economy towards debt deflation, a shrinking money supply. Japan has been like this for 30 years as they pay back the debts from their 1980s excesses. It's called a balance sheet recession. Using future spending power to inflate asset prices today is a mistake that comes from thinking inflating asset prices creates real wealth. GDP measures real wealth creation. Policymakers didn't realize bank credit impoverished the future as they thought banks were financial intermediaries, but this is not true. The central banks started revealing the truth in 2014, about 35 years too late. Before 2008, the bankers brought future prosperity today, and everything boomed. The claims on future prosperity built up, out of sight and out of mind. Once it became apparent, these claims on future prosperity could never be met. A financial black hole opened up that was ready to swallow the Western financial system whole. Banking should be so easy. Bankers get to create money out of nothing, through bank loans, and get to charge interest on it. What could possibly go wrong? Bankers do need to ensure the vast majority of that money gets paid back, and this is where they keep falling flat on their faces. Banking requires prudent lending. If someone can't repay a loan, they need to repossess that asset and sell it to recoup that money. If they use bank loans to inflate asset prices, they get into a world of trouble when those asset prices collapse. Its nearly $14 trillion pyramids of super-leveraged toxic assets was built on the back of $1.4 trillion of U.S. subprime loans, and dispersed throughout the world, all the president's bankers. When this little lot lost almost all its value overnight, the Western banking system became insolvent. Wall Street can turn a typical asset price bubble into something that will take out the global economy using leverage. I cannot stress the importance of knowledge, it outweighs temporary preps every time. It could be civil unrest, economic collapse, or world war, or all three at once. Think critically, my friends, time is short. And since banks give me zero interest for my savings, I have zero interest in banks, and I keep all my cash away from any financial institution. I know by doing this, I'm halfway there in being prepared. This was the Atlantis Report. Please like, share, and subscribe. Thank you.